of recession, so what's the probability we'll be in a recession this year versus maybe 24?
Good question. Well, I mean, our indicator would say, there's a little better than a coin flip odds that at some point this year we'll be in a recession. And if it doesn't happen, one scenario could be the Fed raises rates to 5 to 5.25, or maybe they even have to raise them more than that because the economic growth is just stronger than expected. But then we come into 2024 with, overnight rates at an extremely restrictive level, and they have been that way for a long time, and costs of bank deposits are creeping higher and higher, and loan growth is slower and slower. So it's almost like if it doesn't happen this year, it's not like the probability gets lower next year. If anything, it might get higher. So.
Okay. And so in terms of sort of where we stand today, where rates are, what impact, and we'll lead this into the JP Morgan First Republic, what impact will this continue to have on the banking sector? Part one. Part two of the question is, as I walked through the halls today, and pretty much the building's empty. People aren't coming back to these offices, or at least they're not coming back anywhere close to what they were coming back before. How does the commercial real estate market play out and impact the potential for the small and mid-sized banks?
Yeah. I mean, if the Fed's going to keep raising overnight rates, and those overnight rates are going to be so much higher than deposit rates at banks, at the big banks and the small banks, but just such a huge gap. If banks have to pay their depositors, I mean, it's not even talking about getting all the way up to the Fed funds rate, but just 1% more than they're currently paying them, the math doesn't make sense for almost the entire U.S. banking system in terms of they have negative net capital at that point. So that obviously can't happen because then all the banks would cease to exist. But what will happen, and what we think will continue to happen, is depositors will realize what's going on here. And the more the Fed hikes, the more attractive something like a money market fund looks for your savings relative to keeping them at a big bank. And banks are just going to lose deposits. And the more and more that banks lose deposits, the harder it is for them to originate new loans, and businesses are going to lose out. And it would be nice to think that, we have this taken care of because look, JP Morgan's just going to absorb all the banks eventually. End game is all deposits are at JP Morgan, right?
You go.
But it doesn't work that way. The smaller banks actually service certain areas of the economy and the financial system, and they're allowed to do that because they're subject to different requirements and regulations than the big banks. So it would be nice to think, this small regional bank in Texas is going under, JP Morgan's going to buy them, and so now JP Morgan's going to do all the commercial real estate loans that Texas bank was doing. Absolutely not.
No.
Because JP Morgan is subject to totally different capital requirements, and they cannot do commercial real estate lending to the level that some of those smaller banks can do. So it's not just all going to absorb and work out. It's a bifurcated banking system, and the banks that are failing serve a very important role in terms of economic growth, particularly around commercial real estate.
So what has to happen in order for the banks to survive a potential extended period of high interest rates, high short-term interest rates?
Yeah, so there aren't a lot of good options. I mean, if you looked at First Republic, for example, which I know is an extreme, but just as a logical extreme, the only solutions there were they somehow get a massive inflow of deposits that are willing to be paid next to 0%, or the Fed cuts interest rates to 0%. Those are it. Those were the only things that were going to organically solve the situation, right? And then you just have sort of, less extreme situations of that, other banks that are, have the same sort of balance sheet situation, just not as bad. And it's the same thing. I mean, I either need to get a whole bunch of free deposits that I don't need to pay for, or the Fed needs to cut rates to 0. I mean, that's basically it. The longer the Fed keeps rates at 5, and the more that depositors know about it, it's sort of like a slow burn.
Yeah.
It's just going to keep happening.
Yeah, the cat's out of the bag. So JP Morgan acquired in an open bidding process. I don't know how many banks bid on it, but I know there were several. Acquired the deposits and certain assets of First Republic, but not all the assets.
Right.
I don't know if you can speak to the details of what they acquired and what they paid, et cetera.
Yeah. So basically, the big thing is they got sort of a sweetheart deal from the FDIC, so a loss share agreement. So that was great, and this is a big reason why First Republic was never going to get bailed out before it went into receivership, because of the precedent the FDIC set with Signature and Silicon Valley Bank, where, hey, anybody who wants to buy these assets before it goes into receivership, just wait, because if you wait until it's in receivership, the FDIC is going to fire sale these things, and you're going to get whatever you want. You won't have to buy anything you don't, and you might get some help on any potential losses. And then the FDIC says this will cost them like $13 billion. So we're up to like almost $40 billion in total losses to the FDIC, Federal Deposit Insurance Fund, because of this. So it just goes to show there will not be private market solutions now. We have 3 situations where if you're a bank looking at buying a troubled bank, just wait.
Just wait.
You'll get it for cheaper and you'll get a way better deal. So, yeah.
Okay. Likelihood we're going to see more of these?
Tough question. I have no idea. I would like to say this is the last one, but that would be stupid to say.
Yeah. I would sense that there's probably a few others lurking out there that might raise their heads up. But is this, maybe the better question, is this systemic to cause a financial crisis?
Well, the difference between this and like 2008 is there are no toxic assets.
Right.
So that's where this is more like a nasty bank consolidation period, probably more like the savings and loans crisis in the early 80s, actually much more like that than the 2008 global financial crisis.
Yeah.
So no toxic assets, probably not systemic. Yeah.